Imagine you are running a legacy utility grid in the Midwest right now.
Right, which is already a massive headache on a good day.
Exactly. And on one side of your desk, you've got these Silicon Valley hyperscalers demanding, localized 24/7 power.
Yeah, huge amounts of power.
Yeah, like enough to run a fleet of nuclear submarines just to train their new AI language models.
Which is unprecedented load growth.
Right. And then on the other side of your desk, you're looking at a weather report showing that a sudden summer derecho just shredded 600 of your utility poles in a single afternoon.
Basically a worst case scenario.
So you're trapped. You're caught between the extreme physical limits of a century-old grid and the absolute bleeding edge of the AI financial boom.
And that is exactly the reality for DTE Energy in 2026.
Welcome to this deep dive. Today, our mission is to decode the DTE Energy Q2 earnings call.
Yeah, featuring CEO Joy Harris and CFO Dave Root.
We're going to pull apart the corporate jargon and look at the real story. We'll hit the headline numbers, the actual physical story behind those numbers, management's guidance for the future, and of course, the bottom line for your portfolio.
Because investing in utility companies used to be, like watching paint dry. It was slow, it was steady.
Very predictable.
Exactly. But right now, with the explosion of AI and data centers, it is suddenly like watching a high-stakes drag race.
I mean, we really have to figure out if DTE actually has the engine to win here.
Well, the through line for all of this is how aggressively DTE is trying to shift its risk profile.
Right, let's get into that, because we need to look at the top line first.
So, the headline numbers.
Yeah, DTE reported Q2 operating earnings of $274 million.
Which translates to $1.32 per share.
Right, the EPS.
Yeah.
And management was very quick to emphasize that this puts them right on track to hit the high end of their 2026 guidance.
So a beat is a beat, right? On the surface, it looks solid.
It does. But when you start breaking down the specific business segments, things get, messy.
Very messy. Let's translate some of this jargon.
Okay, so DTE Gas was down $10 million year over year.
Not great, but normal fluctuation.
Right. Then DTE Vantage, that's their custom energy and renewable natural gas platform, that was actually up $14 million.
Bringing them to $45 million.
Exactly. And energy trading saw a nice $17 million bump up to $41 million.
Plus the corporate and other segment was favorable by $18 million.
Right, so all that sounds fine. But here is the glaring red flag. DTE Electric, their absolute core engine, earned $270 million.
Which sounds like a lot.
It does, until you realize that is a $48 million drop compared to the second quarter of 2025.
Yeah, that is a huge hit.
I mean, if this is such a strong quarter, why did their biggest segment contract by almost $50 million?
And if you're just running an automated stock screen, a 15% drop in the core operating segment, it triggers massive alarm bells.
Right. And on the call, management blamed it on, quote, higher rate-based costs, colder weather, and this is my favorite, the timing of taxes.
Ah, yes, the timing of taxes.
I mean, come on. Is this just accounting magic to cover up a weak spot? Or is there actually a real business reason here?
It sounds super suspicious, I know. But if we dig into the SEC filings, it's actually not a cover-up at all.
Really? Because blaming taxes feels like a classic Wall Street deflection.
It does. But this is about how investment tax credits, or ITCs for green energy, are recognized on the balance sheet.
Okay, walk us through the actual mechanics of that, because a $62 million swing is a lot of ledger manipulation.
Right. So in 2025, when DTE placed a massive renewables project into service, the accounting rules let them take a huge tax benefit right at that exact moment.
Oh, so they just got a massive concentrated bump.
Exactly. In Q2 of 2025, they absorbed a $62 million positive hit all at once.
Just a giant windfall.
Yeah. And that windfall was actually just plugging a hole from a negative tax impact they took back in Q1 of 2025.
Wait, so if you were an analyst trying to model their cash flow last year, it must have looked insane.
Completely volatile. You had a terrible Q1 and then an artificially inflated Q2.
And it had nothing to do with how much power they actually sold.
Zero correlation. It was just based on what specific month they flipped the switch on a solar array.
Right. And institutional investors hate that kind of lumpiness.
They absolutely despise it. So starting in 2026, the accounting rules changed.
Okay, so what did they do?
Now, the impact of those tax credits is amortized. It's recognized evenly throughout the entire fiscal year.
Oh, I see. So that $62 million injection that spiked last year's Q2, it just isn't there in Q2 of 2026.
Right. The benefit is still real, but it's smoothed out across all 4 quarters.
So that $48 million drop in DTE Electric is basically a ghost.
Basically, yeah. You're comparing a newly smoothed out quarter against an artificially spiked quarter from last year.
Okay, so that translates to much higher predictability for investors going forward.
Exactly. The underlying operations are actually highly stable once you strip out that tax noise.
All right, so that solves the tax mystery. But Dave Root also blamed rising rate-based costs.
And this is where we have to leave the spreadsheets and look at the physical world.
Right, Mother Nature versus the grid. Because to understand why these costs are rising, we have to look at what just happened to Michigan.
That July storm was brutal.
It was a severe, fast-moving system right at the start of July, and it completely caught the weather models off guard.
Joy Harris spent a lot of time on the call talking about the sheer logistical nightmare this caused.
Yeah, I mean, it knocked out power for 400,000 customers.
And she pointed out that the predictive models utilities use to pre-stage crews, they just flatlined. The wind spun up too fast.
And the physical damage was staggering, over 600 broken utility poles.
But the key detail she emphasized, and this is crucial, is that the damage was primarily caused by trees falling from outside the utility-maintained right-of-way.
Wait, so what does that mean in practice?
So DTE spends millions clearing the zones directly around their wires, right?
Sure, standard tree trimming.
But if you get unmodeled wind shears that uproot a massive 100-foot oak tree sitting 50 feet away in someone's backyard.
Oh, wow. The right-of-way clearing doesn't even matter.
Exactly. The kinetic energy of a tree that size falling will just snap a standard wooden utility pole clean in half.
Taking down all the power and telecom lines with it.
Yeah. And because this was a wide-scale regional event, DTE couldn't just rely on local help.
Right. They had to ship in crews from as far as Oklahoma and Texas.
Over a holiday weekend, no less.
That has to be an unbelievable cash burn. Overtime, logistics, housing.
Which feeds directly into those rising rate-based costs. You can't just keep taking these hits on the chin.
So what's the fix? Because patching it with the same wooden poles clearly isn't working anymore.
That's why DTE is pushing an $11 billion 5-year capital investment plan.
$11 billion. That is a massive grid hardening effort.
They essentially have to rebuild the physical topology of the system.
Let's break down those 4 core pillars because it really shows how they're trying to engineer their way out of climate risk.
The first pillar is technology and innovation, basically automating the grid at scale.
Right. Harris said they installed over 700 automated devices in 2025 alone.
And they want a fully automated distribution system by 2030.
What does an automated system actually do, though?
It's all about SLISR technology, fault location, isolation, and service restoration.
Okay, plain English for us non-engineers.
So on an old grid, a tree snaps a line, a breaker trips, and thousands of homes go dark. A guy in a truck has to drive around to find the broken wire.
Sounds incredibly slow.
It is. But with FiliSR, smart switches instantly detect exactly where the voltage dropped.
No, so it finds the fault itself.
Right. It isolates the damaged segment and automatically reroutes power from a different circuit.
Wait, so the network essentially self-heals?
In seconds. An outage that would have hit 3,000 people is suddenly isolated to just the 50 houses right under the fallen tree.
That is incredible. But you can't put smart tech on a brittle grid, right?
Exactly. Which brings us to pillar 2, infrastructure resilience.
The physical hardening. They hardened 200 miles of grid in 2025, and they're ramping up to 1,700 miles of pole-top maintenance in 2026.
Swapping wooden crossarms for fiberglass, upgrading the wires to handle higher wind loads.
And the third pillar is modernization. They rebuilt over 70 miles of 4.8 kilovolt circuit.
Which is fascinating because that 4.8 kilovolt system is an absolute relic of early 20th century Detroit engineering.
An ungrounded delta system, right?
Yeah, it's wildly inefficient. You lose a ton of voltage over long distances, and you absolutely cannot run modern FLSR automation on it.
So they have to rip out the old legacy system and upgrade it to a modern 13.2 kilovolt grounded system.
So to get the baseline architecture needed for those smart switches to even function.
Which takes massive capital. And then the fourth pillar is just sustained tree trimming. Moving away from reactive surges to a permanent maintenance program.
So the obvious question from an investor is, does this $11 billion plan actually have an ROI?
Are they getting a return on that reliability?
The data says yes. Harris noted that from 2023 to 2025, overall outage duration improved by 90%.
90%, that's massive.
And in the 5 storms right before this wild July anomaly, they restored 97% of customers within 24 hours.
So the engineering thesis works. The hardened grid is working.
It is. But this creates a massive affordability paradox.
Right. You're a regulated monopoly. You spend $11 billion on poles and wires. How do you do that without doubling the average citizen's electric bill?
That is the friction point with the regulators. DTE's defense on the call was pointing out that their residential bills are still 17% below the national average.
And represent less than 2% of the median Michigan household income.
So they're arguing the current rates are affordable.
But standard cost cutting isn't enough to fund $11 billion in the future. To keep consumer rates flat, DTE needed a miracle.
And they found that miracle in Silicon Valley.
Which brings us to management guidance and the data center gold rush.
This is where the story gets really wild.
The scale of the AI boom is just hard to comprehend. DTE is securing massive large load numbers. They have 2.4 gigawatts of executed agreements right now.
2.4 gigawatts. Let that sink in.
You've got an Oracle data center at 1.4 gigawatts already approved and under construction. It's the largest in the state's history.
And a Google facility at 1.7 gigawatts, just waiting on regulatory approval.
I mean, to contextualize 2.4 gigawatts, that is roughly the output of 2 massive nuclear reactors.
Dedicated entirely to processing AI.
Dropping right into Michigan's lap. But how does this actually help everyday people lower their costs?
It's all about fixed costs. A regular residential grid is spiky. Everyone turns on their AC at 5 p.m., but uses almost nothing at 3 a.m.
So the capacity factor is low.
Right. But these AI data centers, they run at a 90 to 95% capacity factor.
Just a massive, steady draw of power 24/7.
Exactly. And because they use so much power consistently, they absorb a huge portion of DTE's fixed system costs.
The poles, the plants, all the stuff that costs money whether power is flowing or not.
Yes. Oracle alone will provide $300 million in annual benefits for existing customers.
Oh, wow. So they are essentially subsidizing the grid for the rest of us.
And Google will provide $1.7 billion over the life of its contract.
That is a staggering amount of margin.
Which sets up DTE for this brilliant regulatory chess move, the stay-out play.
Ah, right. Explain how this works with the Michigan Public Service Commission.
DTE goes to the MPSC and says, look, approve the tariffs we need to capture this data center margin efficiently.
And in exchange?
In exchange, DTE promises not to file another electric rate case for standard consumers until at least 2028.
A rate case being when they ask for permission to raise everyone's bills.
Right. So the MPSC gets a huge political win by keeping rates flat for years. DTE gets the cash to fund their grid upgrade.
And Silicon Valley gets the power it needs. It's a win-win-win.
But the analysts during the Q&A were looking even further ahead. They wanted to know about the pipeline.
Because DTE has another 5 to 6 gigawatts in the pipeline, right?
Yeah, including 2 gigawatts in advanced discussions that they want to sign by the end of 2026.
But if you have all these hyperscalers just begging for power, writing blank checks, why does it take so long to sign the next deal?
Analyst Anthony Quaudel asked exactly that. And Dave Root clarified that the bottleneck isn't finding tech customers.
What is it then?
It's local zoning.
Ah, the politics of land.
Right. The tech companies have to secure massive plots of land, get it zoned for heavy industrial data use, get site plans approved.
All before DTE can even execute the power agreement.
So the friction is entirely at the municipal level.
Which introduces some risk. And speaking of risk, let's talk about the credit downgrade Julian Dumoulin-Smith brought up in the Q&A.
Yes, regarding Oracle.
Right. Oracle recently had an S&P credit downgrade. So I have to ask, are we building a multi-billion-dollar grid expansion for a tech company that might default on the bill?
It's the ultimate stranded asset fear.
But Root seemed completely unbothered by it.
Because they have built incredible contractual armor into these deals.
Break that down for us. How is DTE protected?
First, they have minimum monthly charges of 80% of minimum billing demand.
Wait, so even if Oracle turns off half their servers, they still have to pay for 80% of the capacity?
Every single month. For 10 plus years.
That is a massive take-or-pay guarantee.
And to address the credit downgrade specifically, they have strict collateral requirements.
So if Oracle's credit rating drops, what happens?
It triggers a clause where Oracle immediately has to post extra financial collateral directly to DTE.
Wow. So the existing retail customers face zero stranded asset risk.
Exactly. The tech company takes all the downside risk.
Okay, so let's bring all of this together for part 4, the bottom line. What are the actionable insights for someone listening?
If you are looking at the transcript, This is a highly bullish signal for long-term holders.
Even with the rough weather and the electric segment drop.
Yes. Those are transient. The structural growth story is completely intact.
DTE reaffirmed their 6 to 8% operating EPS growth target through 2030.
And utility earnings will make up 93% of the total by then.
But the kicker, which they confirmed in the Q&A, is that this data center pipeline provides an upside to that guidance.
An 8% plus upside if they execute on that pipeline.
But how are they paying for all of this? We are talking about massive capital requirements.
They need a pristine balance sheet. They target an FFO funds from operations to debt ratio of roughly 15%.
Which means they need equity to balance all the new debt. About $500 million in equity issuance annually.
Normally, that would mean severe dilution for shareholders.
Right, flooding the market with shares. But they locked this in for 2026 using forward sale agreements.
$350 million in Q1 and $150 million in Q2.
Which means they locked in the price, but they don't actually settle the shares until Q4.
So they secured the funding without immediately diluting the current EPS. It's incredibly smart treasury management.
Okay, what about the politics? It's an election year.
Right. Dumoulin-Smith asked about that too.
And DTE expects absolutely zero legislative reform this year, right?
Because it's a divided government. Gridlock is their best friend right now.
Yeah, if the current rules are working perfectly for them, why change them?
Instead, they are just focusing on educating candidates. Show them how data centers keep residential bills low and boost the local tax base.
So, to summarize, DTE Energy is managing an incredibly delicate balancing act.
A historic pivot, really.
They are fighting increasingly unpredictable weather with an $11 billion physical grid upgrade.
And they are using the insatiable power demands of AI giants like Google and Oracle to foot the bill.
While protecting the residential consumers from rate shocks, it's impressive execution.
It really is.
But I want to leave you with a larger philosophical question to mull over.
Oh, the macro view. Let's hear it.
If tech giants are essentially paying for and dictating the expansion of the Midwest's power grid, does that shift the ultimate balance of power?
From local government regulators to big tech?
Exactly. When a utility's growth relies almost entirely on Silicon Valley, who is really controlling the infrastructure of the future?
That is the million-dollar question.
Is it the voters in Michigan or the hyperscalers in California? Something to think about if you're holding this stock. Thanks for joining us on this deep dive.